Welcome back to the Arizona housing market update. You know, it's been a second because I moved and I had to change some setups and you don't care about any of that. So let's just get right into it. First thing I want to talk about is some of the news stories that jumped out to me this week. First comes with the news of Moody's downgrading the US credit rating. What exactly does it mean and what are the impacts of this? Back in 1919, Moody's first gave the United States its pristine AAA rating, but with recent concerns around the growing $36 trillion debt pile, it became the last of the three major credit agencies to officially downgrade it in May of 2025. The downgrade had little effect on the stock market, but with consumer sentiment, it led to higher Treasury bond yields, which brought increased mortgage rates and increased borrowing costs for Americans. The 30-year officially ticked past 5%, while the 10-year yields, the one that mortgage rates tend to track, near 4.5%. And by no means am I an expert on treasuries, but it's fascinating to learn more about. Technically, the rise in yield is a good thing. It means investors have less fears of a recession, and they're not rushing to the security blanket of the US government. Instead, they're putting their money into places like real estate, stocks, or corporate bonds, things that have higher returns but typically come with more risk. So investors as a whole are feeling more confident to put their money in places they normally wouldn't in a downturn. But with that increase, like I mentioned earlier, it means mortgage rates and borrowing costs also increase. If a bank could place millions of dollars, essentially risk-free, into the government and earn 4.58%, why on earth would they lend it to John Smith, the car mechanic, for only 5%? Who would you trust more? John, we know, is a trustworthy guy. He pays his bill on time, and he isn't the US government at the end of the day. So because banks can earn passively on less risk, they have to increase the yield they receive so they can lend to John Smith comfortably. John, I don't love you at 4.58%, but I love you at 7. What do you say? But now you might be asking, if mortgage rates are at 7%, wouldn't that mean that the economy is in a worse position? Wouldn't this slow down demand to purchase homes, causing prices to fall and creating fears of a recession? And if there's fears of a recession, more people go back to investing in the government, which lowers how much they earn by doing so, which then decreases mortgage rates, bringing more demand in the market, and the cycle continues. Okay, I might have lost every single viewer on that tangent, but is it fascinating? What can we do to win around here, huh? Winning makes you lose, but losing makes you win. What a time to be alive. So long story short, mortgage rates increased this week. Another headline that made waves, Trump says he's looking to take Fannie Mae and Freddie Mac public again. He tried during his first term, but it didn't really happen. Back in 2008, after massive losses during the housing crisis, both companies were placed under government conservatorship. This means that they've been effectively run by the federal government ever since. As of 2019, studies show that over 70% of US mortgages are backed by the government programs. These include Fannie Mae, Freddie Mac, FHA, VA, and Ginnie Mae. The system supports easier credit standards, especially for first-time buyers, and it also broadens lender participation by reducing risk. If these companies were fully privatized again, the assumption is that credit requirements would tighten, the focus would shift towards profitability over accessibility, and they'd likely be less aggressive about backing loans for borderline or low-income borrowers. It could also result in slightly higher mortgage rates, as private companies would need to bake in an extra 0.25% to 0.5% margin to account for risk and profit. I can't predict whether this will happen or not, but so far, the only major impact it's had is a spike in the stock price. Since Trump made the announcement, the stock has jumped over 44%. But here's the catch. This is a public company run by the government, so the usual rules don't really apply here. There's no dividends, no voting rights, and no guaranteed value. The entire bet is simple. If Freddie is released from the government control, the stock could explode. But if not, or if the process stalls, the price could crash just as fast. If you're looking to buy, sell, or invest in Phoenix, I'd love to help. Reach out using the email, phone number, or comments below. We also saw Trump back off on a lot of the tariffs he announced. But life comes at you fast. This morning he threatened a 50% tariff on the EU. Again, this is as of filming around noon on Friday the 23rd, 2025. If you're interested in learning more about how these tariffs could affect you, if they do ever happen, I made an entire earlier video covering it in depth that I'll link in the comments below. It'll also be in the description. So these are stories from across the nation, but let's get to Arizona specifically now. We'll start with the confidence index, which has dropped since our last video. If you go to the main dashboard here, we can see that the confidence index is currently sitting at a 74.0. And this is dropping since our last video was around the end of April. We were around a 77.7. Beginning of the month, we were around a 77.2. And now we're at a 74.0. Not super fantastic. The reason for this is both the supply and the demand index. So we can see, starting with the demand index, this is only going back to April on this specific chart. We can go back further, but this gives us a broad market view. We can see that we were somewhat consistent, kind of bouncing up and down, but as May gets deeper and deeper, we get less and less demand. This might be from some of the rate increases, it might just be summer weather, and it might be total coincidence too, if I'm being super honest. I mean, the drop from 82.3 to 80.8, it's lower, but it's not as significant to make that big of a difference. It was already less than 100, so it was already a weakened demand. This is just a small amount over time. If this continues month over month, and now we end up being in the 60s by the time it's November, then that's gonna be no good. But for right now, in the small little window that we can tell, it's slowing down, but this is as expected for the summer months. And if we go to supply, it's gonna be the exact same story. Typically in Arizona, supply increases throughout the year. December, there's almost no new homes, almost no transactions happening. November, it's pretty slow as well. January, that's when a lot of them start to happen, and then they slowly build up through the summer months. So it went from 105 to 109.1 now. Technically, we're still in a neutral market. You can see here, it's not quite at that 110 mark that would shift it over into even more buyer dominated with even more inventory. So we're on the edge there, but the thing here that we want to look out for is it's starting to flatten a little bit. If it continues to flatten, fantastic. Going into the summer, if we were at a 109, that'd be awesome. But if it starts to get worse, if this creeps into the, 112s, 115s, that's when things are gonna start to get even worse. So this could drop into the 70s if this continues to rise. And we're gonna be able to see this daily. I mean, we started at 78, now we're down to 74. I mean, this is happening almost every day. We're getting a couple point differences. So it'll be interesting to watch over the next couple weeks to see where this goes. Now, the thing I wanna touch on is this weekly updated chart. We can see here that it's been a couple weeks since I did this video last, but there has been a lot of change in the market. Just in this last week, we are seeing 11% decrease in Chandler. We're seeing a 13% decrease in Scottsdale, 10% decrease in Glendale, and we're seeing Paradise Valley hanging there with 0. How one is red and one is green is 0, it's beyond me. But what we're really looking at here is there's only 4 green arrows, which means besides Goodyear, so maybe even technically 3, there's only 3 to 4 increasing markets. Buckeye and Maricopa, which were at 54 and 53, so there really only is room for them to go up. And then Fountain Hills, which is interesting. That is a very specific neighborhood. It's a little bit higher end, a little more luxury, so that doesn't surprise me as much. Sometimes when it's a higher end buyer, the rates don't matter as much because they're purchasing cash anyways. But for seeing these bigger areas, like Chandler specifically, seeing 11% drop, I mean, this is pretty huge, because if we go down to the week prior to this, because I haven't done this in a couple weeks with the move, this one is May 15th. So Chandler was at the week before, or month before rather, 134.3. They dropped 13% that week. Glendale, 9%, Scottsdale, 12, Gilbert, 10. So we're seeing these big drops, but now take that over into this week, Chandler's down again. So they started at a 134 and now they're at a 115. This is a pretty drastic change overall. And we're seeing for Scottsdale, this is now under 100. So initially a week ago, we were still in a seller's market, but things are starting to change and it's trending south. But I do want to know, as you can see in this chart, as Playboy Cardi would see, you're seeing a whole lot of red. The thing that we're noticing is the market is cooling down. It feels significantly fast because we're coming off of craziness from 2020 and 2021. If all this chart here said 300, 350, 325, 310, 275, if we were at these numbers coming down to 100, it's an insane amount of change. So it hurts us more because of that. And we have maybe more panic inside of us. But in reality, it's just shifting back to a normal neutral market state. Things balanced around 100 is not terrible for a lot of the major cities. The Gilberts, the Mesas, the Tempes, the Phoenix, Glendale, Buckeye, Maricopa, Queen Creek. These are kind of outskirt markets that they were already less competitive to begin with. Even in 2020, Buckeye was not that hot of a market. So seeing this, it's really not the end of the world yet. What we're really seeing here is the markets are becoming a lot more neutral. Even though we have Chandler at 115 still, we have Phoenix at 103, some of these things kind of shifting towards sellers, I would view them as almost all the same. Anything from that 95 to that 115, the way it will feel today is that it's neutral. Buyers are going to be getting concessions, you're going to be seeing price drops. So if you have a product that you're bringing to market, more and more are going to pop up over time. I would make sure that you're pricing it correctly if you want to sell. You might think if I price something at, let's say 680, that if we sit longer, there's more of a chance of getting 680. But if 4 of your neighbors pop up, now you might be lucky to get 640 because of what's happened to the market over time. There's more supply, less demand, and now you're just one of the pawns on the board. So just be aware of what you're doing when you're listing your home if you're looking to maximize value for it. If you're holding it for the long haul, don't worry about any of this. In the next couple of years, all of this will be different. You're gonna be in a good spot. This is city specific, but I wanna show you something that's happening on the zip codes. This is going to be our contract ratio heat map. What's interesting about the Comfort Report is, first of all, what an awesome tool that we have that gives us all of this data, but it shows you even zip code specific of where deals are happening. So we can see here, here we go. There's not a lot happening right here. Shocker, right on the airport. I don't expect there to be a lot, but there are some hot pockets. So Tolleson, 85353. This is considered a hot area. We have El Mirage, we have 85029 in Phoenix, and then we also have Tempe 85284. So it's really interesting to see because most of the valley you consider, I'm kind of an East Valley guy, so I'd consider kind of this pocket to be something I'm more familiar with than the Surprise, Goodyear, Peoria, Glendale area. But you're gonna be seeing that a majority is considered to be a balanced or warm market. What's interesting though is as you creep into Scottsdale and a lot of these Airbnb markets, you start to get to cold, colder, and coldest. I mean, there's no surprise here because no one really wants to live right on the area, but right on the airport. But you're seeing Tempe, which is pretty cold for a college town. Right here, you're going into kind of Papago Park area. You're getting into Old Town. A lot of these things are still, they're sitting longer. And I have a listing as well that we're noticing that anecdotally as well. So it's interesting because if you have a home in a specific zip code, you might want to know whether you're in a hot or cold area to know how to price. So if you're interested in finding out your zip code specifically, whether it's hot, warm, cold, or whatever that looks like at the time of viewing, comment that down below and I'll reply with the answer. Now, one more thing that I want to show you is as the market is kind of in this slow progression towards a neutral state, I want to show you something that's gonna be more important as you go to actually purchase a home for yourself. So first of all, when you're looking at Zillow and you're looking at a lot of these online tools, Zillow, Redfin, Compass, they're not really giving you the full picture. I could be wrong. There could be some random location, some crystal ball that you can find out all this information. But from what I understand, it doesn't show you this. So if I was to go and, for example, I'm gonna sell a home in the islands. Normally, if I was doing this, I would choose Agritopia, my favorite neighborhood in all of Arizona, but I want a little more sample size and there's really only 100 homes in that area. Islands were probably triple, around 300. So if I just pick, this is even the extended islands. If I go here, and I just want closed listings. And then I want anything that's closed in the last 182 days, fine, 76 of them. So I did this earlier because I knew what I was going to see was going to be insanity and I wanted to have some information prepped for you guys. So look here, I had the exact same list, you'll see. I just did close and I went 181 days back, same square, and I went to list view and then I thought, okay, what's gonna be interesting is what is the amount of concessions paid on all of these properties? You saw this close for $425. Did it really close for $425? Or is Zillow just going to tell you that and now you have a little bit of misinformation going into the deal? So if I go down to detail here, and I might have to blur some of these details, I'm not sure. The first one I click on, okay, this part was not planned at all. The first one I click on had $13,687 in commissions paid, or sorry, concessions. So what that means is, if we pull up our handy dandy calculator, we go to 425 minus 13,687. That's really only a $411,313 home. Crazy, but you wouldn't know that by looking at the public data that's available for most of the, public. So now if I'm just going through these homes, we see 2% concessions, 2% concessions, 3.5% concessions, 6,500. Let's just pick another random one. 2,800, 1%, $4,000, $8,000, $5,000, $5,000, $13,000. So this is a $515,000 list price home that sold for $500, and then they got another $13,000 back. So, It's super interesting. If you're a seller, you can just know that this is coming. Expect some concessions to be paid. And if you're a buyer, you can get creative. You're expecting at least $10,000 based on public data. It's a 51% chance, which we take those odds, really, to get $10,000 to your account. So concessions can be paid for a rate buy down, whether that be short-term or long-term. They can help you cover closing costs, or let's say that you aren't a big fan of some of the landscaping or maybe some of the paint color. You can prepay some of the vendors through escrow with concessions to get those renovations done. You can even prepay your HOA dues for a year in advance. So there's a lot of ways you can get creative to use this money. And if you don't ask for it, you're basically throwing away free money. If you have this, let's just say, for example's sake, we pull up the calculator one more time. On this home, they end up closing at $500,000, which I already kind of have in here. And let's say that you got a 6.74 rate, which would be whatever. 6.7 is fine. Your payment would be $3,200 a month. Now, let's say that you could get the, $13,000 instead off your purchase price. So now we'll just do the exact number that it could be. Minus 13,240. That would be a $486,760 purchase price. Now your payment's $3136. So negligible difference. But now let's say you use that money for a 2-1 buy down, which would probably cost you around 10 grand. Okay, we go back to 500,000 for a purchase price, and now we do 4.7. Now you're at $2,500 a month. Now the next year comes around, now you're gonna be at 5.7. Now you're at $2,800 a month. And now eventually you will land back at that 6.7, but how much money did you save when you were at 3,200 minus 2,500, okay, times 12. So you save $8,400 on year one, okay? Now, let's see, we were at 2,800, 100 minus 3,200 minus 2,800 times 12 plus, what was it, 8 grand? You save $12,800 over those 2 years, which is pretty awesome. Now keep in mind, the buy down was probably only gonna cost you, like I said, around $9,000 to $10,000. So for 9 grand of value, you got back at least $12,800 of it. And then you have another $3,000 that can cover your out-of-pocket costs. So now you have less payment for the next couple of years. And if rates do decrease, we can refinance, which will even help us save more. But let's say they don't, you can use that 9 grand to get back 13, and then you can use another $3,000 to pay off some of your closing costs. So overall, there's a lot of ways you can get creative. If you're working with the right team, you can understand some of these tools are available to you and some of the contractors you need, some of the vendors, some of the lenders, whatever that looks like. This is a really cool opportunity for buyers. And if you're a seller, just be ready for the ride. You're still in a great position. You're still gonna be better off than in 2008, 2011, whatever that looks like for you today. But just know that you're gonna be paying some concessions. Whatever you think your neighbor's house sold for, it probably didn't actually close for that amount once you see the back-end data. So the market as a whole is continuing to slow down. Slowly, more and more opportunity exists for buyers. Homes are offering concessions, builders are offering crazy incentives, and the summer should bring more to light. Nothing seems drastic just yet, but I have this weird feeling in my stomach. Something just feels off. Consumer sentiment is at one of the lowest levels we've seen in a while, and household debt is also higher than we've seen since 2004 or longer. This is just the data I have. But despite both of these facts, people are continuing to buy. April 24th, 2025, the Fed noted that there is a disconnect from what consumers have been saying and what they have been doing. So whether you are a buyer, a seller, or just an everyday consumer, just be a little more aware of the lifestyle you have today. It's hard to say where things are gonna go, so maybe take it easy. Avoid bad debts, don't use buy now, pay later tools like Klarna, and stop spending on the TikTok shop. I mean, come on, guys. Thanks for watching. Let me know your thoughts in the comments below. I'll see you in the next video.